On a quiet Monday evening, when the screens had gone dark and the world seemed to hold its breath. When institutional desks were empty and retail investors were deep in sleep, something extraordinary occurred in the shadows of the silver futures market. $10,655. It didn't happen during regular hours. There was no advanced warning, and it didn't move in stages. It ignited in minutes. But the question isn't just where the price jumped. The question is, what broke? And more importantly, what does this violent price dislocation reveal about the structures holding our financial system together? Because when a market moves like this in the darkness of off hours trading, it's no longer a signal. It is a warning. Welcome to Dollar Age. If you've made it this far in life, built something of substance, or stewarded capital through multiple market cycles, then you understand that the most dangerous financial moments rarely announce themselves with fanfare. Do me a favor, would you? Hit that subscribe button below. Not for entertainment, but because informed decision-making requires analysis that doesn't insult your intelligence. And drop a comment. Let me know where you're watching from, London, Singapore, New York, or Sao Paulo. Because what we're about to examine creates a butterfly effect that touches every market in every corner of the globe. We begin by looking where most were not watching. At 6:00 p.m. Eastern Time, when the traditional floors were dark, a different engine began to roar. When the lights go out at the major exchanges in New York or Chicago, the financial world doesn't actually sleep. That is where Globex, the CME Group's electronic marketplace, operates nearly 24 hours a day. It is where foreign institutions trade and algorithmic systems execute orders while the rest of the world dreams. Usually, it is a quiet place. But minutes after the open, the silver chart went nearly vertical. A gap and run scenario. To understand why this is terrifyingly abnormal, you must understand the nature of liquidity. During regular hours, the market has depth. Market makers and thousands of participants keep prices orderly. But on a Sunday night, liquidity is paper thin. In a thin market, prices should not explode upward. They should drift or consolidate. Violent crashes happen when no one is there to catch the falling knife. But an upward explosion tells a different story entirely. It reveals that a major entity appeared with extreme urgency and massive size. They were willing to pay significantly above the market just to secure a position immediately, without waiting for liquidity. This isn't speculation. It's a symptom of a deeper desperation burning behind the numbers. Because while the world bets on paper, the physical vaults are facing a much harsher reality. Silver is a unique entity in the commodity world. The vast majority of futures contracts are merely paper agreements, bets on price movements with no intention of ever touching a physical bar. It's a game of illusions. But a small percentage of those contracts require physical delivery, and this is where the picture starts to fracture. For 18 months, registered silver inventories at the COMEX, the heart of the U.S. precious metals market, have hovered at historical lows. Registered carries legal weight. It means the metal is available for immediate delivery. Meanwhile, open interest remains elevated. In plain terms, there are too many checks being written and too little cash in the vault to honor them. Analysts have been shouting about this imbalance for months, showing data and warning of a supply squeeze, but mainstream media chose to look away. Then came Sunday night. The price explosion on Globex stripped away the facade. There's a violent tension between what silver is supposed to cost and what someone is willing to pay to actually get it. Look beyond the futures market. Physical coins and bars are trading at premiums of 4 to 6 over spot. Dealers report scarcity, national mints are weeks behind, and refineries cannot keep pace. If silver were truly abundant, these conditions would not exist. They do exist, leading us to a number that mining executives are terrified to mention in public. 13,000 tons. That is the annual deficit between how much silver the world mines and how much it actually consumes. A deficit that has persisted for 3 consecutive years. Imagine a massive reservoir feeding a city. Every year, more water is consumed than the rain can replenish. At first, no one notices because the reservoir is vast. But year after year, the waterline drops, revealing cracked mud, until one day you look down and realize the buffer is gone. That is where the silver market stands today. The mining industry faces a reality that technology cannot yet fix. High-grade surface deposits were exhausted decades ago. Today, to get the same amount of silver we got 10 years ago, miners must move more rock, process more material, and consume more energy. And here is the ultimate paradox. Nearly 70% of new silver is a byproduct of mining copper, lead, or zinc. This creates a strategic trap. Even if the silver price rockets, miners cannot simply increase production because their primary business is copper. If copper demand softens, silver production falls, regardless of how thirsty the market is for silver. This disconnect between geological reality and industrial necessity is no longer a forecast. It is a head-on collision with an unstoppable demand engine. That demand engine is not a trend. It is a mandate of the era. The world is committed to a green transition, and silver is the soul of that shift. Solar panels do not might need silver, they require it. Each photovoltaic panel uses about 20 grams of silver in its conductive paste. Currently, there's no commercial substitute that matches silver's efficiency at scale. In 2020, the solar industry consumed 100 million ounces. By 2023, that number surged past 150 million, and the trajectory isn't slowing. China alone is installing solar capacity at rates that were unthinkable 5 years ago. Europe is accelerating, and the US is pouring billions into domestic supply chains. Every panel installed is silver permanently leaving the market. Then look at the EV revolution. An electric vehicle uses double or even triple the silver of a traditional car. Battery management, charging infrastructure, electrical systems, all of it craves silver. With global EV production projected to jump from 10 million units in 2022 to over 30 million by 2027, do the math. That is hundreds of millions of ounces of new demand that didn't exist a decade ago. But what makes this structural is the defense sector. In an unstable geopolitical environment, global military spending is skyrocketing. Modern missile guidance, radar, and satellite equipment are silver-hungry monsters. While demand sectors are growing at a breakneck pace, global mine production has been flat for 5 years. This isn't a temporary strike or local disruption. This is a fundamental mismatch between the Earth's geology and the needs of civilization. The Sunday price spike wasn't the start. It was the moment the market realized a fierce new chapter has begun, one where paper currencies are starting to feel the heat of dilution. In March 2020, the U.S. Federal Reserve created more dollars in 3 months than in the previous 100 years combined. Stop and read that again. A century of monetary expansion compressed into 90 days. Central banks in Europe, Japan, and the UK quickly followed suit. Economists call it quantitative easing, but there is a rawer term, dilution. When a company issues too many shares, the value for existing shareholders evaporates. The same principle applies to currency. When trillions of new units are pumped into the system, the money in your pocket doesn't become worthless, but it is certainly losing value. Those who truly understand the rules, family offices and generational wealth managers, have begun to move quietly. They aren't buying more currency, they are buying physical gold. In 2022 and 2023, central banks accumulated gold at levels unseen in decades. But here's what most missed. Gold gets the headlines, but silver is what truly worries the planners. Why? Because gold is purely monetary. Silver is the backbone of the very technologies governments claim are priorities for national security. The fragmentation of the international monetary system is pushing silver into a position of extreme asymmetry. As the BRICS nations discuss new commodity-backed payment systems, and as they watch foreign reserves frozen overnight, an old truth has resurfaced. What is held in another nation OS banking system is not your asset. It is a permission that can be revoked. Physical metal in your own vault is the only thing that requires no one's permission to hold its value. That Sunday spike was the price of collapsing trust in monetary stability, leading us to a cold question every strategic leader must face. There's a question that separates professional capital allocators from the rest of the world. Not what happened, but what does this mean for tomorrow? The Sunday price spike may have passed, but the structural fracture it exposed remains, looming like an iceberg in the financial ocean. Now is the time for a strategic response. Business leaders are facing a calculation unseen in decades. Their operating environment now includes a commodity that is simultaneously becoming scarcer and more essential. Silver is not an optional input. It is a requirement for the technologies that define competitive advantage. When the pricing mechanism sends a violent signal like this, old assumptions must be discarded. Be honest about the scenarios. The base case is a prolonged deficit with price escalation and violent volatility, requiring patience over timing. The bull case is a monetary crisis, forcing institutional capital into hard assets, making Sunday gaps a routine occurrence. And the bear case, a global recession, might temporarily cool industrial thirst. But in any scenario, ignoring the signal is a fatal mistake. The real lesson here isn't a tip to buy silver, it's a total reassessment of resource availability. The era of cheap abundance is over. The new world requires a different mindset. Resilience over efficiency, security of supply over lowest cost, and strategic reserves over just-in-time management. Silver is not unique, it is a pioneer. Energy, copper, lithium, everything required for humanity's next step is following this script. This price shock is a preview of a global repricing, where the world realizes that what it needs is no longer found at yesterday's prices. Wise stewards of capital don't ask if this matters. They ask, how do I position for what is coming? Where will you stand when the final warnings are issued?